All right, good morning, everybody. It's my morning. Good to have you here. Let's talk about the purpose and intent of these free bonus live QAs. I want to make sure that you understand the strategy. So that's the main purpose of these. There is a section on the research site that has a 19 or 20 or 21 page PDF that talks about the approach. So I think it's right now called education. Jules may have changed it to start here. So this is not a place where you get financial advice. I am not your financial advisor. I would be if you signed a financial advising agreement with me. The hat I have on now is a researcher or a market participant or a market observer. So that's what I'm doing. I'm observing the market and sharing my observations with you. So no financial advice. I know a lot of times people have financial advice and they ask what they should do. I have an entire company. It's a training company. I train your brain. You train your brain. I train your money. You train your money so you know what to do when you're supposed to do it and how you do it. It's an incredibly powerful training course. And I personally think that's actually what people want is the training course. They don't know they want it, kind of like Ford knew people would probably want faster horses and not a car. I actually do believe people want to be trained to act and be the way they want to be, regardless of what's going on. So for many, it might actually be the training course. You can ask me questions about the strategies. Some people email them in. Some people ask them here. You can. I can also answer like economic questions or just general questions, but no questions about, hey, what do you think I should do or how much should I buy? That falls into something very, very different. And again, you can ask me a question and it can be private, as in no one else sees it. Or you can just go ahead and ask it to the whole group and I'll answer it. So whichever one works for you, I have that. Okay. So let me first just do a review. So we have that, and then those might bring up some questions, some concerns, some issues, some judgments. I'll answer all of them, and then we can move from there. So we have on the screen here S&P 500. We have three lines. The black line is what the S&P with dividends closes each day. It's the closing price. The blue line is the 70-day exponential moving average. The 161, or the red line is a 161 exponential moving average. So look, it's going up and to the right. I'm not sure there's much to add other than up and to the right. Clearly, we had a big correction in the last quarter of 2018. Jerome Powell changed his point of view on raising the federal funds rate 3 times in 2019, completely reversed and said, okay, I won't, and in fact has already dropped rates. So we live in interesting times. I believe the Fed is watching the German yield market. I believe the German yield market is running the yields for the entire planet. That's what we have, meaning this is the market we have, not the market we may want. Next, I'll just quickly show you. I think what I want to show you is this chart right here. I think this is in the top 5, maybe, most important charts. I got to be careful when I say most important charts in the world because there's lots of them, but I believe the most important chart in the world is the S&P 500. That, I mean, even if you're not in the US and you live in the UK or in Germany or in China or any of the other 200 countries, the fact that the S&P is the most followed stock index on the planet, it should be what you measure against, even if you're Australian. But this is a very important price chart. This is the bond market, IEF. IEF, this is a 7 to 10 year US Treasury bond ETF being divided by the S&P 500 dividends reinvested. So what I find interesting about this is if the line is falling, if the black line is falling, that means bonds are underperforming stocks. So this is bonds including dividends reinvested being divided by the S&P 500, including dividends being reinvested. And as you can see on the screen, the yellow area is an area that has my attention, right? So it's not quite 2 years old. It's about 18, 19 months old, and bonds have been holding their own against stocks. You can see down here it broke below, and you can see down here it broke above. But it didn't sustain itself below the yellow zone, and it didn't sustain itself above the yellow zone. And then I did also put in these trend lines because I just kind of see this. I want to see, is this true? I think that's what I'm wanting to do. Like, is this trending higher, or are the trend lines really two trend lines there and two trend lines there? It could very well be that, and this angled one is more of a, if I was a bond bull, I'd want this black line to go higher. But you can see every time the black line pops its head above the yellow zone, it gets whack-a-moled back down. And this is important because this is basically the battle between the bond market and the stock market. And it's very clearly showing here that it's been going back and forth with a drop down below and a peak above. So to me, this is one of the most important price charts on the planet. XLK is one of the sectors that the second question says, okay, well, given the answer to the first, where's the strength in all the different ways you can slice and dice the investment world? XLK is one of them. That's technology. XLU is the bond, the utility market, utility stocks. So again, not much to add up and to the right. I got rid of XLV finally. I'm a little sad, and you know, I'm willing to be open to feedback, and like, you held on to it too long, and I get it. The reason I kept it is because the blue line never crossed below the red line. And that's important, considering that during this correction here, this correction for XLV was 15.7%. The stock market fell 20, technology fell 22, other markets fell even more. So it corrected in a much calmer fashion. The blue never crossed below the red, which it did in every other sector. And I was willing to give it some time. But it hit kind of its 1 year mark of going sideways. And so I finally said, I've given it a year. And it's here's the good part about this approach, this research. If you look at the two questions, question one is if in or out, and then if in where and if out where, but in or out. And then question two is if in where and if out where. What's great is of the 100% of the portfolio, 10% was on this line. And that means 10% went sideways for a year. And I've got to say, if I looked at someone's portfolio and 90% was doing well, and 10% was in XLK, and 10% was in XLU, and 70% was in IVV, I'd be like, damn, you're doing pretty good. So I'm fine with letting it take a little longer. It got replaced with XLRE. XLRE is real estate, and this has just been looking beautiful. It's 5% in XLRE right now, and then I put 5% into GDX. There's not much to say about XLRE. It's doing great. There are some comments to say about GDX. This is GDX, precious metal mining shares, and not the metal gold. So it had to break above some barriers. Clearly, it hit this resistance, which I was aware about, and it's correcting down. I don't see this correction over here as of right now being severe. And it would be expected to have it come back to the blue, maybe even down to these lines here. But what I'm mainly really watching is I'm just kind of paying attention to gold. And gold broke out. Trying to think. I'll just zoom out, guys. It's easier. I'll zoom out to 7.5 years. Gold broke above, basically about that. And so I did a beautiful job breaking above it. I'm going to zoom out a little bit more, and I'm going to get rid of this bottom. I'm going to get rid of this down here. Because it's distracting me. And then let me just go out maybe to 10 years. We're looking at actual gold. Now this gold's priced in dollars. So it broke out of this. I talked about this for a while, that this kind of this 1385 range was important, and it broke out of it in a good way. I also said if it broke out, we should expect a correction to come down and test it, so I wouldn't be surprised. Also, too, there's a lot of resistance up here, typical, like healthy resistance. So one should not be confused if gold hit kind of the 1550 to 1580 range and said, oh, let me take a breather. But I think the genie's out of the bottle. This is gold priced in dollars. If you price it in British pounds, if you price it in euros or Swiss francs, it looks even more impressive. So this feels like a pretty impressive move. It was sideways for 6 years, a beautiful bottoming pattern. So I believe gold's going to follow the direction of the German yield, meaning it's going to take its cues from the German yield. And if you looked at read or watched my vlog for this week, I said I actually think major asset classes on the planet, gold, US stocks, US interest rates, are really looking at what the German yields are. Because this broke out right here when the German yields broke down to new lifetime lows. And I'm going to predict that their yields go much, much lower. I don't know what the prediction is as far as, is it negative 2%? I mean, the fact that the German yield hit, let me just find the German yield so we can talk about it. So here's the German yield right here. This is going back 10 years. The bottom chart is the S&P 500. Does that not look like a mirror? One's going down, one's going up. But here's let me get rid of this bottom part again, just so we can. Here are German yields. They broke the zero mark, which some believed, including me back in 10, 11, that government bonds would never break zero, but they did. They broke it here. Okay. Came back above, broke down below, not a big deal because the world knew that yields were already this low, but they broke below to new lifetime lows right about here between those two blue lines, like right there. Now, can German yields come back up and retest the zero? Of course. That's a huge move down. As you see huge moves down, there's correction moves down, there's correction moves. So I would not be surprised to have a correction move. I don't know what stops this from going lower. I know something's going to stop it from going lower, but I just don't know what it is right now. So I do have a prediction that German yields will hit -1%, -2%. They hit -0.71, so -71 basis points. Right? This is Germany, guys. Germany, not Argentina or even Brazil. This is Germany. They're the 5th largest economy. US 1, China 2, Japan 3, Germany 4. They're the 4th largest economy on the planet. And if you bought their 10-year treasury, it was yielding -70 basis points. So I don't know where it ends, but we haven't even gone into the deep recessions or recession. This is just pre-recession. The world's still kind of getting by. Maybe the trade war resolves itself and this yield comes up to zero, and then something else comes out, or Deutsche Bank goes to zero and this goes back down. But I believe the world's watching this rate. And that's why I wanted to talk to you about it right here. And that's why I put it in the blog. So I think that's it. There were a couple questions that came in. I have to go look for them. As large groups of retired people give up on having large bond positions as future long-term interest rates rise, what will the general effect on the market be? Yeah, so there's this belief that the bond market is smarter than the stock market. And I've had this idea lately that what if the bond market isn't as smart anymore? Or what if it's becoming dumber? Like because of these zero interest rate or a zero interest rate or a negative interest rate world, like how smart can a bond market be when you have zero yielding or negative yielding? I don't know. I'm just putting the question out there. But for decades, people have said the bond market is smaller than is smarter than the stock market. I don't know. Maybe it's not anymore. Maybe with 78 million baby boomers in total retiring, right? What, 10,000 a day? How's that going to affect things, right? Because as you get older, you want less price volatility. And people have been taught bonds are safe, stocks are dangerous, right? They've never been trained to actually look at the market and to train themselves to go, well, let's set aside past ideas and just show me what's trending higher. Not anything, but let's look at the four asset classes. And people need to be trained to behave that way. And people have not been trained to behave that way. So I don't know how it's going to fully work out, right? Because we have more and more people retiring, not less. We know they buy more and more bonds. We know when someone buys a bond, the price goes up and the yield goes down. But that wasn't your question. Your question is, eventually, here's the assumption, eventually interest rates stop falling. And I think that's a fair assumption to make. The question is when. They've been falling since 1981, 37 years-ish, something like that, 37, 38 years they've been falling. Eventually they'll stop falling. And then when yields go up, price goes down. And this might be what really takes out people over the age of 60, right? It's one thing for them to buy a 10-year treasury yielding 1.5% and knowing they'll get their money back and they'll get their 1.5% a year. But what happens if we actually do go into an inflationary, not hyperinflation, but just let's say we get back, let's just say we reflate, right? Let's say in the future a 10-year treasury is 5%. Well, if you go to sell your treasury that's yielding 1.5%, you're going to have to sell it at a huge discount because no one's going to want to pay face value for a bond yielding 1.5%. So people who would go sell, they're going to lose money in an area where they did not expect to lose money. And the reason is they've been taught to think that way. And they've never been trained to go, okay, let's set aside, some of these old beliefs and what's really working. So the answer is, I don't know. It's likely that people over the age of 60 will get hurt the most because they've been taught to pile and put money into, air quotes, the safe bonds. Now, if we don't get a huge reflation, but we just kind of get back to kind of normal and it goes sideways, then again, those bonds aren't going to have the same power they've had the last 35 years because yields go down, price goes up. So now they're not going to get the boost from the price. They're just going to get their 2 or 3% or maybe 4%, which in a future where maybe a 10-year treasury is not 1.5, but maybe it's just 3% or 4%, you're going to see inflation in other products out there. So I think what's going to happen is people over the age of 60, people who have not been trained, and by the way, I'm not training you right now, we're just having a conversation. I think they may get hurt again. But one thing I'm pretty sure about is the last recession was not caused by bonds, and the recession before that was not caused by bonds, or the stock market correction had nothing to do with bonds, right? The 2008 global financial crisis was a real estate thing. The 2000 dot-com crash was a technology thing. So it's probably not going to be technology stocks again, probably not stocks, probably not real estate. Commodities have been kind of asleep and confused and moving around the forest confused for 4 or 5 years. So there's probably not going to be a commodity thing, that kind of leaves us bonds. So it's very likely that the next trauma will actually be in the area of bonds. Unfortunately, right? I mean, it's sad, but again, because people have been taught and not trained, there may be potential pain, unforeseen pain. Okay, a couple more questions that got emailed in. Why GDX over GLD? Like, okay, I get RC that gold has broken out. Understand, but man, GDX. Actually, let's put GDX and GLD up here. Oh, I got to do it over here. Okay, hold on, guys. Nope. I'm losing part of my screen. Okay, here we go. So yeah, GDX is the red line, gold is the blue line. And if you kind of just, let me just find, maybe this, let me just see if I can find a good example. This might be a good example right about here. So this is about 6 years. 1, 2, 3, 4, 5, 6. This is about 6 years. The blue line is gold. It's actually GLD. And the red line is GDX. So clearly the red line is a leveraged play on the blue line. When the blue line falls, the red line does worse. When the blue line goes up, the red line clearly does better. So one of the things that gives me appropriate confidence in this precious metal move, of course we're going to have corrections, is precious metal mining shares are outperforming the metal. Silver just finally woke up and is outperforming gold. So it's buying GDX has lots of liquidity. It gives you good exposure. And if the gold thing is real, meaning if this breakout is real, then simply owning GDX, one symbol, is just a powerfully simple way of having a position and not having to go with all different positions and individual stocks and this and that and whatnot. It's kind of a very simple way of getting a position in gold. But of course, look, some people don't want the price volatility. And then you could just buy GLD. Remember, the Fearless Wealth portfolio, it's a model portfolio. Okay, any questions from you guys that are here with me in regards to things that I've gone over, or maybe questions that I've stirred in your brain because of what I've covered? If there is, you can go over to the Zoom group chat and you can just go ahead and type in the question. Or if you want me to unmute you, then I can do that too. So let me go back here. So if you're finding yourself kind of nodding along, but your portfolio isn't in that powerfully simple way, then I think it's time for us to get on a phone call and talk about what training might look like for your life. Not just for your money, right? But what type of steward are you? How much control do you have over your future in regards to what's going on right now? Do you have to trust and like your advisor because you don't really know what they're doing, even though you may like him or like her? Because the training literally trains your brain to think differently and see the world differently. And it's very hard to get stressed out and overwhelmed and have angst when you've trained your brain and trained your money. It's an incredibly powerful experience. And the way I can kind of sum it up, and then we'll hit the pause button, is, you know, when you bought your new car, or you bought that car, and let's say you bought the VW Bug and you drove it off the lot, all of a sudden your brain naturally saw every other VW Bug on the road. You didn't have to work out or work harder or go to night class or go get a master's or an undergrad, your brain naturally, automatically, immediately saw all the other VW bugs on the road. And that's kind of what training is, right? Training is, it's not effort. It's more like, oh, wait a second, I just see things I didn't see before because you trained your brain. I trained your brain to just see the things you're supposed to see, right? And that allows you to sleep better at night. That allows you to say, okay, I'm in control of my money. I know what's going on. I don't have to panic, regardless of who tweets what or who posts what on what news agency. And the answer, it's not going to be found in a ticker symbol because, and you know this, you can give healthy food to someone, but if they haven't been trained to be healthy, it doesn't matter how much kale you put in their fridge. And you could put Twinkies in someone's fridge, and if their brain's been trained, they'll just go find clean, great food for them. So the Twinkie or kale, that's the ticker symbol. It's not the ticker symbol. It's what you do with, right, information that comes in front of you. And it's not more information. It's actually getting trained. Okay, guys, I got one question that came in, and then we'll hit the pause button. Should we have stop losses under our positions? So again, that's kind of a financial advising question. I can't tell you whether you personally should have a stop loss or not. I don't know you guys individually. I don't know what keeps you up at night. The way that the model portfolio and Fearless Wealth Research manages its downside is through absolute price charts and relative price charts and the moving and crossing and signaling of moving averages in a very specific way, which once the signal comes, you still have to know how to step out and step in. And those are very powerful things, and they're nuanced ideas and things, but they're important points and differences. And it's one of the things that I train people to automatically, immediately know what to do. So I don't know if you should. The strategy does. The Fearless Wealth strategy does. Thank you guys for being in my world. I appreciate it. Email the questions in. We'll talk again next month. Again, if you find yourself with more than, 3 or 4 ticker symbols, or just having some discomfort with the markets unnecessarily, as in you shouldn't have any, the next step is the easiest, and it's for us to speak on the phone, and we'll just talk about what's working and what's not working to see if even the training is a fit or how it might be. You guys are so great. Thank you so much. I'm going to hit the pause, and I'll talk to you soon. Take care.